Adrian Mowat, Managing Director and Chief Asian and Emerging Market Equity Strategist at JP Morgan, joins us. Adrian, it's always a pleasure to have you with us. Thank you very much for dropping into the studio. Well, first up, the markets itself. What's the sense you're getting? We have moved a good 10 percentage points from the recent lows, and now the globe, as it were, has started to slide a bit. Do you think this is stoppish, 8,300, tough to make to breach that level?
No, I actually think India will go back through its sort of 52-week high. I think we had my colleague Barry at IO on recently. We've had, one of those sort of troubled summers again. The third quarter was particularly bad, and we learned a lot more maybe about the Chinese economy, or perhaps the generalists learned more about the Chinese economy. We had that big sell-off in the A-share market. We've had a lot of confusion around the Fed. But I think if we then look at some of the detailed data, the European growth numbers are actually good. It's growing above potential, particularly peripheral Europe, places like Spain growing at 3%. We just had some good economic data again out of Europe. I think also we've got that good data with the European Central Bank remaining very helpful, and Draghi continuing to make good comments, talking about more QE, which is certainly necessary in Europe. Remember, Europe's still got a lot of debt, deflationary pressure. Then we would expect the Bank of Japan to do something as well. And we're still reasonably optimistic that Prime Minister Abe will pursue reform. And then we go and look at the US economic data. Perhaps some of the data points for the last month or so have been a little bit weaker. But the non-farm payrolls continue to expand. Private credit creation is growing at about 6%, which I think looks pretty good. So I actually think the world's not that bad. Some of the data we're seeing in economies like Korea, where housing sales are strong, car sales are strong. So I think if we look at the data and maybe get a little bit less caught up in the markets, I think there are some reassuring things out there.
We love your optimism, Adrian, as always. You always make us look at the glass half full rather than half empty. But, just coming to, just trying to play the devil's advocate here, we are starting to see some weak spots emerge in some of the earnings performances. So, for example, private banks and pharma, some of the cleanest companies there, the likes of Axis Bank, Lupin, are starting to show slower growth signs. Would you worry about what trends you've seen this earnings season?
Yeah, so I think, well, it's relatively early. I think we're about sort of 35% of the way through. And, we've had we're sort of looking at the numbers, and there's sort of more beats than misses. So on a normal statistical ratio, not too bad. Some of the private sector bank numbers have actually been quite strong as well. So I think that there are some specific issues, and we've got some interesting guests coming on where we can particularly talk about the monetary transmission mechanism. I think really the problem in India is that we're running real interest rates that are too high, particularly if you think about real interest rates, about where inflation is, a year from now. And that's why credit growth has been relatively weak. And I think it's difficult to expect the corporate sector to invest when you're giving them such a high real interest rate. And I think when thinking about real interest rates, you probably shouldn't just think about the CPI number. You should look at the GDP deflator. And if you think about the mix in terms of inflation for the economy, we've got WPI, which is actually in deflation. And so I think this is the issue, and we need to get a new framework when it comes to where interest rates are in the world, but maybe particularly in India. And we look at India and Indonesia as two countries where we think the central bank should be doing more from the, from the perspective of the investor in the economy.
Okay. Well, even if the central bank cuts, how much will the banks pass on still remains a question. But we'll come to that in just a bit, Adrian. We have its results season. So we have one conversation that we were having with Adrian Mowat. He's right here with us in the studio. Adrian, one of the biggest losers this morning is Axis Bank. It's down 6.5%. And sorry to keep coming back to that discussion, but you have a couple of private sector banks that you're overweight on as well, names like HDFC Bank and ICICI Bank. There has been increased stressed asset formation for the likes of Axis Bank. Would you worry that the worst is not over in terms of stressed assets for this sector?
So typically the way this works, we're running real high rates in India, so you are going to get less credit growth, and you are going to get asset quality problems. And I think the way the equity market's going to view this, that if the RBI remains on hold, then you're going to get further stress developing. If the RBI was to surprise us and cut rates, then I think the equity market would look through that. But it does seem to me to be logical that with real rates rising, especially when we use the WPI as a deflator, that you will get distressed assets.
Okay. The passing of rate cuts has not been what it used to be. In fact, the difference between the Reserve Bank's repo rate, which is 6.75, and the base rates, the average of base rates that we have, is the highest today than it has been in the past several years. So, I mean, this transmission issue will keep coming back because banks are putting away money for their stressed assets. So, when does this logjam break?
Well, it's a good question. I think we might ask this to some of the guys coming on later. This is a big issue for investors. You know, why is the monetary mechanism not working as efficiently as it has? And maybe it is a function of distressed assets, but maybe I would probably just go back to the more sort of Econ 101 view, is real rates are too high.
Okay. Speaking about Axis Bank itself, the stressed assets were more than what the market was prepared for. Would you rethink your investments in private sector banks in general?
Well, I think, you know, we've just been listening to the Tata Communications story, and their results were different than some of the other companies' results.
Yes.
I think there's a story here where you don't say buy private sector banks. You're maybe more specific about what you're willing to buy. And there's definitely a story of certain companies executing better in these conditions.
Okay, you did mention when we started off that you expect to see the Indian markets back at their 52-week highs. So what are your projections? By Diwali, where do you think the markets could be? Are we staring at 8,500?
I'm not going to make these short-term predictions. You know, we sort of think by June next year you could easily be back above the highs that we've seen in the last 52 weeks. You know, and if we look at our projections for emerging markets, you know, 6 weeks ago when we're saying 925, which was a 16% return, that looked very high. It's now 5% return for the balance of the year. But next year we actually think EM could do very well. And you start to sort of drill down and look at the key companies in the big indexes, such as in China, Korea, Taiwan, and India. You know, I think they will be generating reasonably good earnings growth, and I think there's a chance to recapture some of the lost ratings that we've experienced this year, particularly since the highs in the second quarter.
Well, the Thermats numbers, that's the first of the capital goods numbers we got. That was a disappointment. Even the order book actually shrunk a bit by about 20%. So would it be largely a consumption-led story?
Look, it has to be for now a consumption-led story. Because to get the corporate capex to kick in, I think that the corporates are obviously looking for a lower real price of money. You know, we keep coming back to the same issue. And from the corporate sector, maybe WPI is more important than CPI. And we've got the gentleman from Punj Lloyd coming on later. It'd be interesting to hear their perspective, although they have been getting some orders more recently, to be fair. So I think this is an issue, and what we probably need is a combination of greater guidance from the Reserve Bank that we're going to get lower interest rates, combined with a government being more effective in spending its money. And we've seen this in quite a number of countries. The first year of an administration, they're actually quite poor at spending money. And it's just the practicalities of getting the right people in place, reviewing contracts, etc. So I would hope for a little bit more of a fiscal tailwind next year, combined with maybe a more accommodative Reserve Bank, and then you could see a corporate capex cycle, you know, gradually beginning to recover. But let's go back to this WPI story. You know, WPI is telling us that there's a lack of pricing power, which one would assume in aggregate means there's plenty of capacity in the system.
So, you know, what about the consumption pie? Because over there as well, we haven't seen any recovery. In fact, we're starting to see some signs of a slowdown, whether it's in the white goods makers, the likes of Hitachi Home, whether it's in the paint companies, the likes of Asian Paints. How do you approach that?
Yeah, I think there is concern around that, but maybe, you know, instead of getting too caught up in the short-term numbers, you know, if you look at India's household debt to GDP, it's about 6%. You know, it's one of the lowest you'll find globally, and I think the way we would approach this is, okay, you get some short-term noise that's less good, and remember that the agricultural sector is feeling, the rural sector is feeling a fair amount of pain at the moment, and it's really probably the urban consumer that's got a slightly better environment and inflation's coming down. And the news around the bad monsoon, the movements in the rupee, all of this could have hit consumer confidence. But when we look at the long-term story for Indian consumption, it remains extremely good. You've got demographics behind you. You've got a very underleveraged consumer. And, we would argue you're probably going into an environment of structurally lower interest rates. And all that will allow a growth in housing, a growth in more expensive discretionary items such as autos. And I would let's look at the medium to long term and maybe understand why you get some short-term disappointing noise.
Well, that's a fair point. I guess even in consumption, it's one company doing well and another not. We had good numbers from Symphony, even if we had bad numbers from Hitachi. So even in the aircon business.
And the other thing about consumption is, people are spending more time on their smartphones.
Yes.
They're consuming technology, they're consuming media. That is consumption. Maybe it's easier to count the number of refrigerators, but there's a lot of consumption going on. It's just what we consume is changing.
Well, the non-bank companies, or would you prefer banks and private banks?
So, again, I think it's an issue of execution here, because we've got an interesting situation in India where, there is aggregate credit growth. Then you've got quite a big part of the financial sector here where their capital is constrained. So those that execute well can eat someone else's lunch as well as be part of a sort of growing pie. And again, it's got to be specific. So, interesting comments here is making about the relative size of their home loan business versus the total home loan industry. There is demand out there, and there are big players who are constrained in their ability to grow.
That makes you wonder about the onset of new technology and how it could really be detrimental for some of the legacy players, right? For example, the onset of payment banks and small banks and how it could impact some of these smaller private sector banks. How are you looking at that?
Well, actually, at JP Morgan, we're worried about that as well. And, we have a $1 trillion balance sheet. I think this is a very important question because, you start off with most customers tend to be a little bit irritated with their banks anyway, and more conscious about the charges. And there are these, very efficient ways of, let's say, transmitting money cross-border, making more efficient small payments. And I think this is a global issue. And where in emerging markets it becomes perhaps a bigger issue is that you've got people who are trying to move into individuals moving into the formal banking system, and they may decide not to move into the traditional old formal banking system and adopt the new technology. If you look at M-Pesa in Kenya, the bulk of financial transactions are being done over a mobile phone, and there hasn't been the sort of move to a traditional bank account. So I think this is quite a big threat. Now, as we look at the story with HDFC Bank, they seem to be adopting technology quite aggressively, and I think that's an interesting thing to talk to the guests from HDFC Bank about.
But that's
exactly. Actually, I'll postpone that discussion to when they come, because we'll. It'll be richer when the players are with us. In any case, I believe that you're going to compete with Apple Pay very soon. There were headlines that you all were grabbing globally. We'll come to that discussion in a bit. Before the bankers join us, I wanted to ask you about the Bihar elections. Would you see it as a referendum on the centre? Would you be terribly disappointed if the NDA lost?
Yes, we would be disappointed. And, I think this would make the next session of Parliament a bit of a red herring, that, nothing is really going to be achieved. And I think there would be a concern about whether the BJP moves to or the NDA government moves to a more populist stance. So at the moment, I think they have been passing some quite tough policies, which is good. Now, with regards to the specific regulations they could be passing, there's a lot of disappointment around GST not going through. I think most people in the market didn't expect the Land Acquisition Act to go through. But GST, there's disappointment with that. And if they do badly in the Bihar election, it sort of feels like it's going to get kicked, well into the future.
So is India still your most preferred market in the emerging market space? And have you increased your allocation to India lately?
No.
Okay. For both?
But no, for both. Actually, we think near-term, markets like China, Korea, Taiwan will probably do better than India. Now, that's partly because India hasn't had the same trouble, the same changes in perception that these markets have had. So I think they have more potential to recover from their lows than a market like India, which has been outperforming during the correction. So, if you're asking me my sort of 3-month view, India wouldn't be my top market. If you're asking my 3 to 5 year view, I think India would still be the best structural story.
All right, Adrian, we yet again take a break from this conversation. We have another guest joining us. We ought to have connected with him much earlier, but we had technological problems. Oh, we still don't. Okay, fine. We don't take that break. Adrian, in the event that the NDA doesn't win, would you see your 9,000 prediction not coming through?
Yeah, I think this could prevent, a quick recovery to the year highs, and it would be perceived as a negative for the Indian market.
Okay.
Okay. Well, you were telling us that a 52-week high is not ruled out. In fact, by the month of June, you expect the markets to touch those highs. So just give us, an expectation of what the sectoral leaders could be from now till the month of June.
Yeah, so I think you continue to sort of focus on quality. So it's the private sector banks that are doing the right things. Within the building materials space, we have a government with a priority on road, rail, and defence. So you think about the government priorities and look for the companies that best execute where those priorities are in place. So I think that's the type of leadership. When we look at maybe the IT space, which has up till now been a big outperformer, I think that'll be less of a focus for investors, because I think we've probably moved out of the period of maximum weakness in terms of FX declines in the emerging space.
Okay. Well, speaking of IT itself, have you reduced your weightage for IT in...
We have in our global emerging markets portfolio. So we were running an overweight in our global emerging markets portfolio. We've moved that to a market weight for Indian IT.
Okay, actually speaking of emerging markets, that was a question I wanted to ask you first. We did see a re-emergence of flows of foreign investors. Is that a trend that is likely to continue? I mean, almost after 13 weeks, we saw that number turning positive.
Yeah, so I think to put this in context, we've seen about $52 billion of outflows from the open-ended funds that you can easily measure. Now, if you put that in context, during the global financial crisis in 2008, there was a $48 billion outflow. And assets under management back in 2008 were greater.
Yes.
So we've had the worst year I've ever seen in terms of outflows. The data last week, I think, was plus 300 million. Yeah. It's barely scratching the surface of outflows. So confidence in the EM story remains low. Although I would say clients...
At least the outflows have stopped. So would you...
Yeah. So we're banging our heads against the wall less frequently. The question is, can we get people to pull the trigger to put more money into emerging markets? Now, the good news is clients are asking a lot of questions, and their positioning is very, very bearish. So the question is, can we draw them over the line? I think we can. We're seeing some positive earnings revisions out of China. I talked about some of the strength in the Korean domestic economy. We're beginning to see a seasonal uptick in tech. Now, if you look at Korean and Taiwanese tech hardware, it's 1.5 times the size of Brazil and Russia combined in the benchmark. So it's important to get tech to work. So that's all coming through, because what really matters here is earnings revisions. So just to put this in context, the EPS integer for emerging markets today for 2015 is 26% lower than the forecast 12 months ago.
Oh,
right. That's a fundamental, massive negative.
Yeah.
Until earnings start to turn around, you're not going to get the flows. Flows follow fundamentals. Okay. Right? That's the key thing. And we spend too much time talking about flows. Flows tells you that someone's made a decision. Markets are about trying to preempt whether someone makes a decision.
Okay. In fact, let's take that theme